Imagine bringing your boss this massive, like, multi-million-dollar project that you just wrapped up.
Okay.
You sit down, you slide the report across the desk, and you show them that you didn't just hit your quarterly targets. You absolutely obliterated them.
Right. You crushed it.
Exactly. Like, you made the company 61% more profit than the exact same time last year. You'd be expecting a promotion, right?
Oh, absolutely. Maybe a parade.
What instead? Your boss looks at the numbers, frowns, and immediately docks your pay by 6%.
Wow. Yeah, that scenario makes absolutely zero sense in the real world.
And none. But that is exactly what Wall Street just did to one of the biggest tech companies on the planet.
It completely breaks the conventional rules of, like, market gravity.
Yeah.
You are looking at the absolute definition of a financial paradox.
And that paradox is exactly what we are getting into today. So welcome to a special time in Market Deep Dive.
Glad to be here.
Now, right at the top, we need to make something incredibly clear to you, the listener. This discussion is strictly for entertainment purposes only.
Right.
We are here to decode the news, analyze the data, figure out how these massive economic machines work. But you should always seek professional advice before making any of your own financial decisions.
Exactly. I mean, we are dissecting the strategies of a tech giant here, not managing your retirement portfolio.
So let's look at the subject of today's deep dive. We are doing a full analysis on the ticker Meta.
Yeah, Meta.
Specifically, we're looking at their monumental Q1 2026 earnings report, their performance so far this year, and this massive fundamental strategic pivot they began back in 2025.
And the stack of financial documents we're pulling from today is, well, it's extensive.
It's huge.
Yeah. We've gone through Meta's official Q1 2026 earnings presentation and the accompanying press release. We've layered that with market data from FactSet.
Right.
And pulled analyst insights from eMarketer, Benzinga, and PR Newswire.
Plus, we didn't just want the institutional view, so we scraped retail investor sentiment from, stock twits, Reddit's, Wall Street Bets.
Oh, yeah, Wall Street Bets is always interesting.
Always. And we even pulled some really granular insights from a YouTube financial analysis breakdown of their earnings call.
So the mission here is to really decode this Wall Street paradox.
Right. We're going to figure out why a company can report absolutely blowout historic numbers, yet watch its stock drop roughly 6% in after-hours trading.
Yeah.
What does this mean for the future of Meta, their competitors, and really your own understanding of how modern tech investments actually work?
It is a fascinating puzzle because, on the surface, the numbers they released are staggering. They look entirely bulletproof.
So, okay, let's unpack this, because we need to lay out the sheer scale of the financial numbers that just dropped to really appreciate the mystery of why the market reacted so negatively.
Yeah, right there.
Okay, so Meta reported Q1 2026 revenue of $56.31 billion.
Wow.
Just to put that in perspective, that is a 33% jump year over year. They comfortably beat Wall Street estimates, which were sitting around $55.5 billion.
And the bottom line is even more aggressive than the revenue.
Right.
Net income came in at $26.7 billion. That is up an astonishing 61% compared to the same quarter last year.
And then there's the earnings per share, the EPS. It came in at $10.44.
Yeah.
The analyst consensus was projecting somewhere between like $6.66 and $6.82. So they didn't just beat the estimate, they lapped it.
Totally lapped it.
And yet, despite all of this, Meta's stock dropped between 5% and 7% in after-hours trading, hovering around that $6.25 to $6.33 per share mark.
Which brings their year-to-date performance to a very modest 1.4% gain.
Exactly. So, returning to our opening scenario, what is the market seeing in the margins of this report card that the headlines entirely missed?
Well, it comes down to a hidden tax anomaly.
Oh.
If you dig past the initial press release and get into the fine print of the earnings report, that massive $10.44 EPS isn't entirely a reflection of their operational success over the last 3 months.
Interesting.
Yeah, there was an $8.3 billion U.S. Treasury tax benefit recognized this quarter.
I actually saw that in the footnotes. It cited U.S. Treasury Notice 2026-7. But rather than reading the tax code, what is the actual mechanism here?
Right.
Because an $8 billion tax benefit sounds less like a deduction and more like, winning the lottery.
Well, to understand the mechanism, you have to look back to the third quarter of 2025.
Okay, taking us back.
Yeah. Under the old corporate alternative minimum tax rules, Tech companies with massive research and development budgets like Meta had to capitalize those R&D costs.
Meaning they couldn't just write them off right away.
Exactly. They had to spread the tax deductions out over several years rather than claiming them all at once. This resulted in a massive, really painful non-cash tax charge for Meta late last year.
So they took a massive hit on the books in 2025 because they couldn't write off their research spending in real time.
Right. And then the U.S. Treasury issued Notice 2026-7, which essentially altered the treatment of those previously capitalized costs.
Oh, I see.
It allowed Meta to recognize a massive chunk of those delayed deductions all at once during this first quarter. So that $8.03 billion benefit artificially pumped up their bottom line.
Wow.
Yeah, if you strip away that one-time tax maneuver, their effective tax rate would have been 37 percentage points higher.
Which means the real adjusted EPS, like the number based on their actual business operations for the quarter, was $7.31.
Exactly. That is the number institutional investors immediately calculated. Now, 731 is still a very solid beat over the 682 consensus.
Sure.
It was a great quarter.
Yeah.
But it completely changes the narrative. It wasn't some miraculous, logic-defying operational quarter.
Right. They didn't magically become twice as profitable overnight.
No. Analysts saw the headline, cheered, read the fine print regarding the tax code, and immediately recalibrated their models.
But I mean, a recalibration shouldn't trigger a 6% sell-off on a solid earnings beat. The tax anomaly explains why they didn't go to the moon, but it doesn't really explain the drop.
Right.
There has to be something else that spooked them.
Oh, there is. You are looking for the $145 billion elephant in the room.
The capital expenditures, the CapEx. This
Yeah.
is where the numbers go from, large multinational corporation to literal nation-state GDP.
Seriously.
Meta raised its 2026 capital expenditure guidance to an astonishing $125 billion to $145 billion. That is up from their previous estimate of $115 to $135 billion.
And they are deploying that capital at a terrifying speed. In Q1 alone, they spent $19.84 billion on CapEx.
See, it's one thing to say they spent nearly $20 billion in 90 days. But what does that actually look like in the physical world? You don't just lose that kind of money in the couch cushions at Menlo Park.
No, you definitely don't.
What are they physically buying?
They're buying the physical foundation of the future internet.
Wow.
We're talking about massive, sprawling data centers,
Yeah.
real estate, raw construction, cooling infrastructure, and power grids.
Okay.
And inside those data centers, they are executing billion-dollar hardware deals. They are buying up specialized microchips and networking equipment from NVIDIA, AMD, and Broadcom at an unprecedented, almost monopolistic scale.
Mark Zuckerberg justified this on the earnings call by stating their goal is to advance, quote, personal superintelligence for billions of people.
Yeah, that was the phrase.
They've essentially consolidated all their efforts into the newly formed Meta Superintelligence Labs, which actually just released its first model.
What's fascinating here is the sheer audacity of the transition. In 2025, Meta completely rebuilt the foundation of its AI program. What we are witnessing right now is the execution of a multi-year pivot.
Yeah.
They are actively transitioning from being primarily a social media platform to becoming a foundational AI infrastructure company.
I hear the vision, I really do, but I have to push back on the scale of the spending. $145 billion in a single year.
That's a lot.
Let's rethink the analogy from the start of the show. It's not just a restaurant owner building a rocket ship. It's more like a wildly successful restaurant owner using all their profits to build a massive, fully automated, AI-driven farm.
Okay, I like that.
The farm is incredibly expensive to set up, right? But the theory is that once it's running, it's going to grow perfectly engineered ingredients for the restaurant, making the food so good they can charge double.
Right.
But while they are pouring concrete for the farm, the investors are looking at the cash burn and just panicking. At what point does aggressive visionary spending cross the line into reckless spending?
And that is the central tension defining this stock right now. Wall Street is looking at a company that built a virtually invincible empire on digital advertising the restaurant, and watching them pour historic amounts of capital into AI compute infrastructure.
Which is really hard to monetize.
Exactly. It's a notoriously difficult field to monetize directly.
So if the burn rate is that high, how are they actually paying for the AI farm without bankrupting the restaurant? Because the physical reality of buying that many NVIDIA chips has to strain the balance sheet.
Well, financially, Meta is in an incredibly fortified position.
Okay.
They're sitting on $81.18 billion in cash equivalents, and marketable securities. And their operations are just a cash-generating machine.
How much are we talking?
They pulled in $12.9 billion in free cash flow just in this first quarter alone.
Wow. But even with that absolute mountain of cash, there's a detail we pulled from a YouTube financial analysis breakdown of the earnings call that really caught my eye.
Oh, the CFO's comment?
Yes. The chief financial officer, Susan Lead, dropped a massive hint during the Q&A session. She suggested that despite this $81 billion cash pile, Meta might actually take on debt or external financing to fund these data centers.
Yeah, that was a huge moment.
Why on earth would you borrow money at current interest rates when you have $81 billion sitting in checking?
It comes down to macroeconomic flexibility. They do not want to completely drain their war chest to build these data centers.
Keep some powder dry, basically.
Exactly. If the global economy shifts, or if there's a sudden downturn in the digital ad market, they need that cash buffer to survive. But the fact that they are willing to take on debt is a huge historical shift for Meta, a company that traditionally relies entirely on its own cash reserves.
I mean, it signals a terrifyingly high burn rate.
It signals urgency. They are telling the market, look, we will not let cash flow constraints slow down our AI construction. We will take on debt if we have to, but this infrastructure is getting built right now, ahead of our competitors.
Which means we really need to look at the engine that is currently funding this superintelligence dream, the digital ad business.
Right.
If the AI farm is the future, how is the restaurant actually doing today?
Well, if we connect this to the bigger picture, you really have to compare Meta to their main rival in the digital advertising duopoly, Google. According to the eMarketer data we pulled, Meta's ad growth rate is projected to accelerate to 24.1% in 2026.
Great, 24%. Google is sitting at an expected 11.9% growth rate for the year.
Yep.
Meta is pulling 24.1. They're growing twice as fast as their biggest competitor in a heavily saturated market. It has to be their AI tools, right?
It absolutely is.
Because I read that they essentially took the steering wheel away from advertisers and just handed it to their algorithm.
That is the exact mechanism driving the revenue. The AI isn't just a future pipe dream about superintelligence. It is paying off right now on the balance sheet. Ad impressions delivered across their apps are up 19% year over year. But more importantly, the average price per ad increased by 12%.
So they are showing more ads, and they are successfully charging more money for every single ad they show.
Right.
How are they justifying a 12% price hike to advertisers?
Because the AI has fundamentally changed how the ads are created and targeted. With tools like Advantage Plus and the integration of generative AI on platforms like Reels, an advertiser is no longer just uploading a static image and guessing who might want to buy their product.
Right, the old spray and pray method.
Exactly. Now, Meta's AI is actively generating and testing thousands of variations of an ad in real time. It matches specific color palettes, phrasing, and imagery to a specific user's psychological profile and viewing habits.
That's hyper-personalization at an industrial scale?
And it results in a massive return on investment for the advertiser. The AI is optimizing the placement with such ruthless efficiency that a small business owner gets more sales from a $100 ad spend on Meta than they do anywhere else. Because the ads work better, Meta can charge a premium.
Okay, so the AI is already turbocharging the legacy digital billboard business.
Yep.
The farm is already producing better ingredients for the restaurant, making it so profitable that it funds the next phase of superintelligence research.
It's brilliant.
It is a brilliant self-sustaining loop. But if the engine is running that hot, what is happening with the fuel?
The fuel being?
The fuel for a social media ad engine is human attention, the users.
Yeah.
Are there cracks in the foundation of their user data?
Well, there are definitely some nuances to parse in the user metrics. Their daily active people, or DAP, hit 3.56 billion this quarter.
3.56 billion people every single day.
It's an astronomical figure.
Okay.
It's up 4% year over year. However,
It's always a however.
right. It actually missed Wall Street's internal expectation, which was modeling for 3.62 billion.
Hmm.
And there was a slight decline quarter over quarter.
Wait, a drop in daily users? Are people finally logging off? Is the algorithm fatigue setting in?
Not necessarily. Meta directly attributed the slight sequential decline to geopolitical events, which is just a hazard of operating at a global scale.
Oh, like what?
Specifically, they cited widespread state-level internet disruptions in Iran and severe restrictions placed on WhatsApp by the government in Russia.
Wow.
Yeah, when entire sovereign nations lose access to the internet or block specific communication protocols, it creates a visible dent even in Meta's massive numbers.
But here's where it gets really interesting, though. Even with those geopolitical blockades, they have 3.56 billion daily users.
Right.
That is nearly half the population of the planet. Are we simply hitting a mathematical wall?
It's a fair question. Like, is the era of massive user growth fundamentally over because they have simply run out of human beings with internet connections to add to the platform? This raises an important question about the life cycle of a tech monopoly. You're absolutely right. You cannot infinitely add a billion new users when you have already captured the entire addressable global market.
You just run out of people.
Exactly. So Meta is definitively shifting its corporate strategy from an era of user acquisition to an era of user monetization.
Meaning, if you can't find a new user to click an ad, you have to squeeze more money out of the users who are already scrolling.
And the data shows they are executing that transition masterfully.
Okay.
Despite the slower user growth and the geopolitical headwinds, Meta's average revenue per user, the ARPU, hit $15.82 this quarter. That metric is growing at 28.2%.
So wait, their user base only grew by 4%, but the revenue they extract from every single one of those users went up by 28%.
Yes, that is the direct result of the AI ad targeting we were just discussing. They do not need 100 million new users if they can make their existing 3.5 billion users 28% more profitable through hyper-efficient AI advertising.
So, what does this all mean? We have broken down the hidden tax anomaly that inflated the EPS.
Yeah.
We've explored the sheer physical reality of a $145 billion CapEx spending spree on chips and data centers.
Yeah.
We've seen how their AI is already dominating Google in ad growth and how they are squeezing unprecedented revenue out of a plateauing user base.
Right.
Let's look at how the wider world is digesting this massive data dump. We have the institutional Wall Street analysts and we have the everyday retail traders. Where's the consensus?
Interestingly, on the institutional side, the sentiment is surprisingly optimistic, which runs counter to the after-hours stock drop.
Really?
Yeah. Analysts at major firms like JP Morgan and Truist remain highly bullish on the stock.
What are they seeing that the algorithms trading in the after hours just missed?
Well, Truist pointed out in their notes that this is Meta's fastest revenue growth since 2021. They directly attribute that acceleration to the AI integration improving ad monetization.
Okay.
And JP Morgan highlighted the financial guardrails. They noted that even though the CapEx is historically massive, Meta is generating so much free cash flow that they aren't compromising the fundamental health of the core business to fund the pivot.
What about the retail side? We scraped the sentiment on StockTwits and Reddit's Wall Street bets.
Oh, yeah.
What are the everyday investors, the people who actually felt that 6% drop in their personal portfolios, what are they saying about this strategy?
Retail investors are generally bullish on the long-term fundamentals, but there is a very visible vocal frustration about the post-earnings stock drop.
I bet.
They see a company that crushed revenue estimates and delivered a massive EPS beat, and they just cannot stomach taking a 6% haircut on the share price because Wall Street got nervous about spending.
There was one specific analysis we found on Reddit, written by a user named Brotha_Eric, that I think perfectly distilled the retail bull case for this massive CapEx spending. It was a great piece of back-of-the-napkin math.
It was a very compelling breakdown of the timeline.
Right. They pointed out that spending roughly $270 billion in total CapEx between 2023 and 2026 seems completely insane on its face.
Yeah, that's a wild number.
But it is a, quote, no-brainer when you look at how it has shifted their baseline revenue. Because of that infrastructure spending and the resulting AI tools, Meta's annual revenue base in 2025 was $85 billion higher than it was in 2022.
Wow.
And with their current projected growth trajectory, they will be printing 150 billion more in revenue per year than they were pre-pivot.
It is a brilliant way to frame the corporate strategy. If you look at it strictly as a return on investment, paying $270 billion once to build the infrastructure in order to secure an additional $150 billion in recurring annual revenue is an incredible trade. The AI infrastructure is already paying for itself. It justifies the pivot entirely.
The disconnect is that the market threw a minor tantrum over the sticker shock of a $145 billion price tag and, some messy tax accounting.
Right.
But the people actually looking at the mechanics of the return on investment, both the institutional analysts at JP Morgan and the savvy retail traders on Reddit, they seem to recognize the genius behind the strategy. Meta is securing the future of the internet while maximizing their present cash flow.
It requires a long-term view. The stock market famously struggles with long-term vision. It operates on a frantic quarter-to-quarter basis.
Right.
But strategically, structurally, Meta is arguably in the strongest, most defensible position it has been in since its founding.
Which brings this massive multi-billion-dollar corporate analysis directly back to you, the listener. Because while we are talking about nation-state level GDP numbers, this is incredibly relevant to your daily life. Every time you scroll through Instagram on your commute, every time you pause for 3 seconds on a reel, every time you click a strangely accurate AI-generated ad on Facebook,
You're part of it?
you are actively participating in and funding the most expensive, ambitious infrastructure build-out in human history. Your daily attention is literally buying the microchips.
You are the fuel that is keeping the superintelligence engine running.
Exactly. Which leaves us with a final, slightly unsettling thought to ponder.
Okay, let's hear it.
If Mark Zuckerberg actually achieves this stated goal, if he spends the $145 billion, builds the sprawling data centers, buys up all the NVIDIA chips, and successfully brings true personal superintelligence to billions of people,
Yeah.
does the digital billboard advertising model even make sense anymore?
Oh, that's a good point.
Right. Or will Meta have to evolve into a completely different kind of entity? Perhaps becoming an essential global utility like water or electricity, rendering the very idea of a social media company entirely obsolete.
Will the automated farm eventually swallow the restaurant entirely?
Exactly. Something to think about the next time you open the app.